or so. Actually, I think I bought my first one at the end of 2018, but nonetheless. Done a lot of transactions in my time right now, actively flipping and invested in small and medium multifamily projects. Also run the Mountaineer RIA. That's where I met Mr. Ray Glimpse here, and him and I have been putting this on for 126 weeks now.
126. Hello, everybody. Ray Glimp from Homeless to Over 100 Doors. Um, Real estate investor. And each and every Tuesday, we love to come to you folks, share some information, see what's going on in the world, and talk real estate. Each and every Tuesday, we enjoy this. So today's kind of a good topic, a timely one, especially with everything going on in the world. We want to make sure that we share some of the things that we're doing actively, make sure that we're buying the right way, and looking at deals the right way too. So.
Absolutely. Views and opinions expressed in this podcast of those, the hosts and guests, do not necessarily reflect the official policy or position of any organization. The content provided is for informational purposes only, should not be taken as professional, legal, medical, or financial advice. Listeners are encouraged to conduct their own research and consult with appropriate professionals before making any decisions based on the information provided in this podcast. Any reliance you place on such information is strictly at your own risk.
Cool. All right, goal diggers, if anybody wants to share any goals that you've accomplished, any goals you want to set forth, I'll share with you folks. I think a good goal for me this quarter is actually, and Seth, you can partake, is to buy and hold, right? To get into a long-term rental, one for tax purposes and two for the cash flow, but to get into additional long-term buy and hold. I think it'd be great to do one every quarter. I think it's quite possible to do one every quarter. Um, and buy right? So we're buying really tight. We're gonna talk about some stuff we're doing. But I know that's my goal. Anybody have any goals that they want to share? You want us to hold accountable before we go on? Go on once.
Chair. I actually just got off the phone with him a little while ago, but I said I host Mountaineer RIA. I think everybody in this group has been to the meet. Yeah, everybody's been there at least once. Love the group, love putting it together. We had two new people this month, which is awesome. I love to see it grow. They actually came and they found us through Facebook, but through Google originally. So Ray and I are kind of looking into how we can tap into that a little bit more. But just got off the phone with one of the new folks, and he has been chatting with a couple of people that were there, and looks like he is working out some business deals. He's a does stuff with mortgages and stuff like that. But it looks like that meeting really benefited him, which is why we do it, right? So that we can get together and make connections and benefit our businesses together. So seeing it in real time happen is very rewarding.
Awesome. Good. Anybody else want to share? Going once, going twice. So speaking of the group, Clarissa invited us to Great Easter Egg Hunt. Thank you, Clarissa, again for that. Kids had a great time.
Absolutely.
So some breaking news. Pretty important. Jerome Powell sees inflation outlook in check. No need to hike interest rates because of oil shock. Um, I want to read the backstory to that though. I'll kind of key in. Um, he says everything's kind of grounded, even as energy prices start to rise. In near term, the right move is to look beyond a short term and concentrate on the Fed's goal of stable prices and low unemployment. And I want to focus on that. I think that is the hidden piece of this is that prices are not stable, right? That might be short term, but low unemployment is the problem, right? And so the Fed either if they have, high prices, they'll raise interest rates. High unemployment, they'll lower interest rates. Well, we got both going on right now. We have high prices and high unemployment, which is a point of stagflation. Fed's kind of powerless in this point. Um, the market just needs to do its thing. But we're in a pretty crazy time. There's also the shakeup in private credit space. Doesn't seem to have the makings of a broader systemic event. I do not believe that. I think that is just the icing on a cake, the canary in the coal mine of what's happening in private credit. Um, and it tells what people need. More people are doing 401k hardship withdrawals. Um, People are tapping into their savings. When you start tapping into your 401k, you're tapping into your future, right? You're at a point right now where you need to hunker down and you need to tap into your future. So when that happens, we're at a very interesting point of weakness. So just be cautious, be on the lookout, continue. We'll continue to share everything we know, breaking news for you folks.
To say that one of the key points in there, it says looking beyond the short-term gyrations of the energy market. I don't know that today, March 31st, we're as sure as we were on, let's say, March the 7th, that this is short term,
Yeah.
right? So the Fed is famous for making lagging decisions, right? Using lagging indicators.
What was it? Inflation is transitory. That was one of the
Yeah.
yeah. And we're
So,
stuck right now. So.
yeah, I would be careful. We wouldn't be careful. I think that he should be careful using things like short-term gyrations. We don't know.
Yeah.
You know, I think that like fuel in general, like, and I just paid $3.99 a gallon for it today. Like I could absolutely see that having a five in the front before this is all said and done, and that's going to do a lot to hurt not just the general person, but investors. Right, your tenants are going to feel this hugely, right, and stuff like that. So it's a big thing. Another thing that I saw too, and I didn't put it into the slides because it came across my desk at 6:15. But about a week ago, I saw that Salesforce was having some major problems. They did some major layoffs because of AI integrations, but they're having problems with their AI and they're kind of regretting letting go of the people that they did. Um, and then I just came across a buddy of mine text me Oracle, which is a major back end product, does a lot of the systems and things like that. They're doing about 30,000 jobs layoffs to fund their AI integrations. So as these big corporations get more and more into AI, you're seeing it that the tech jobs and things like that, those are some of the first ones to go. You're seeing that these companies are investing these big money. So unemployment's a problem. Unemployment is going to be a little bit more of a problem. And it's not average Joe unemployment either. It's college educated unemployment. But also like there's factors that go into like these companies not realizing what it takes to actually implement this AI as well.
Yeah. Speaking on that, I'll just give you guys Oracle lays off of up to 30,000 people, which is roughly about 18% of their global workforce. So think about that.
1 in 5.
Huh?
One
One
in
in five.
five.
Yeah. And then you start to think about the other picture of what AI is doing and how it's shaping the world. And I told you, Seth, I created 3 apps, right? One was for my business, one was for my bar restaurant business. We created that app with a system I'll share with you folks here too. It's called Lovable. I'm not sponsored by it or anything. I'm just sharing it with you folks because I've got a ton of value for creating apps and systems, right? So we created it for the bar business, but then I created it in my handyman and maintenance business, right? Where my maintenance guys are now, they can clock in and out. They can send pictures and pretty much the scope of work is organized for them, right? So I was using what used to be called Monday.com. I was using Monday.com. That was $300 or $600. They charge you about a seat, actually. So it's 300 for me and an extra 150 per person. I just got rid of that, right? And I created my own custom app, looks special. And then I just did if you guys use DocuSign or I use Signwell, I created a digital sign app, right? Well, I need to do a sign paperwork. Most of the paperwork stays between us, between clients and stuff like that. I created that, right? And so that DocuSign membership and that DocuSign subscription, those prices are going down. People are leaving them and switching to more resilient systems at a fraction of the price. And so what that does cut Seth's dead on. This is usually we'll have like a blue collar. The last recession we had was like a total blue collar. You have some white collar, but it's mostly blue collar. Right now, this is like a white collar recession, college educated recession. Went to school, got a degree in coding. I don't know if I need to code anymore. Right? What used to take 10 people to do a project is now one. And so that's what I would be concerned about. But on the flip side, we're gonna have people, and this is why we're gonna segue into the buy and hold. You're gonna have people with a big lifestyle change. If you go from making $250,000 a year, $150,000 a year, $100,000 a year, and now that money isn't there, you might lose your house. You got to sell your house because you can't afford it. You can't find a job to replace it. You take out hardship loan, you might make it 3 months, you might make it 6 months, you might make it a year, but kids' daycare starts adding up, those fees start tacking on. What happens? You go into a rental market. You sell your home, you can try to buy another one, but we know the hardships of that. And then eventually you go into the rental market. And what's going to happen? This is the same thing that happened in 2008, last global financial recession we had. It put more pressure on the real estate and the rental market, actually. And I think that is going to be the swing of everything, is that we'll see, again, people are going to try to find the rentals in the single family homes. That's going to drive up pricing. It's supply and demand, right? Apartments should do all right. People don't want to live in an apartment, but hey, look, if it's affordable, I got to go where it makes sense financially for me till I can get back on my feet. All right. So some people might be a downgrade. For others, it might just be what makes sense. You might see migration patterns that don't make sense. West Virginia, we saw an 18% increase in migration. Why? Why is that? Is it because it's affordable? Right? So those are some of the things I would be thinking about, and I've been thinking about. Um, Change your house, change your car, change your eating out behaviors, everything. I agree. But the problem is, I think so many people are so tapped out of changing, eventually you just get priced out. You could cut on Netflix and cut all your subscriptions that you want, right? You could sell your car if you have equity in your car. That's another trick, right?
Yeah.
Most people might not have equity, especially if you bought during COVID. You bought at the height. I bought my last two cars. I bought at the height of COVID. I didn't have any equity to trade.
You hardly ever did. I was in the car business for years. I would routinely roll $10,000 worth of negative equity into the next car purchase, and I would say that 60% of Americans that have a car note have negative equity, and most of them have the last car that they purchased. They rolled in negative equity from their last car.
Let's
So it's a vicious cycle in the car industry because it's a depreciating asset,
mhm.
whereas real estate's appreciating.
And let's even think about this and talk about this. The car payment, average car payment in America pre-COVID, like a nice car was $500. You get a really nice car for $500. Good luck getting a car for 500. I think Tesla has, like, you could finance one, a rear wheel drive Tesla for 529, right? You might be able to get something okay for $500 a month. Average car payment through the United States, I think it's anywhere from $800 to $1,000 though. Right? So try to sell your car, but you need a car to get to work. You need to commute. Going Uber or public transportation might not be an option. And then finally, it's to change your house, right? When we mention like foreclosures are getting bad, those are all warning signs, guys. We've been saying it for a long time. Like, this was coming. Changing your house is the last step people make. And it's the most painful step you will ever have to make in your life. I hope and pray none of you folks on this call have to make it. But it'll probably be the most painful step of knowing a comfort, knowing a home, and then having to lose it and leave it behind because of something.
There's bank rate. The average U.S. car payment, new cars $750 to $770 per month. Used cars $530 to $550. The headline says most people quoted anywhere between $700 and $800 a month. A large chunk of buyers are way above that. Nearly 1 in 5 new car loans are $1,000 or more a month.
Yeah, that's what I thought. So when you think about that, what a mortgage is, what a car payment is, right? Car payment is now a rental payment.
Yep.
That's crazy to think about, right? So I think it's just something for everybody to understand, take note of, and be cognizant about, especially when we're starting to buy. Let's go into the next slide so we can kind of get into the news or get into what we're doing. So we're looking at buy and holding. Um, you got to look deeper behind the numbers, all right? Most deals look like the left. Oh man, this is gonna be all right. We're gonna be good until a storm happens, right? And real estate storms could be good. All right. Some storms could be good for you. But you can't always assume you're gonna have the best. During COVID, a lot of people assumed that they were gonna have the best. We got 2 or 3% interest rates. Oh, it'll go up, but it'll be back down in a year, 2 years, 3 years, 4 years, 5 year. War happens, 5 years, 6 years. Rates are going back up even more now. Okay. Um, one of the things is rent growth assumes stable conditions, right? You're not always guaranteed that rent growth though. Okay. You buy at today's rates or lower. Expenses are consistently underestimated. What does it cost? What does it really cost? Okay. If you need, get estimates. Financing is modeled as predictable. None of this is predictable, ladies and gentlemen. It is to some extent. To some extent, it could be predictable. But there are the hiccups. There are the questions. There are the what ifs. Okay. You need to think about those. Don't simplify the long-term risk. What we are talking about right now is a long-term risk. What's happening right now, $4 a gallon, $5 a gallon, this is a long-term risk. This affects everybody. This isn't just like, oh, okay, this is just your area. No, this isn't just United States. This is Canada. This is the Philippines. This is everywhere. It affects everybody. So think about the long-term risk. Don't simplify it. I think that's one of the biggest points about what we're speaking about.
Kind of the biggest thing is when people are underwriting, they make those assumptions, right? Like I'm going to see 3% rent growth year over year, and I'm going to hold it for 15 years. So, I'll be at this at the end. And there are calculators that factor all that in, right? And factor in what's your return on investment, your ROI, cash on cash return, all those different things at year 2, at year 5, and year 10. But that they don't factor in the unknowns that go into it. And I think that's the biggest point of this slide, right? Is that you gotta understand you're gonna run into oh shit moment
Mhm.
at some point, right? It may
Yep.
be an appraisal. It may, who knows, right? It may be an unforeseen capex.
Yep. And that is one important part to just having reserves, making sure you buy right. So that's kind of why we share this with you folks too. Let me hit the next one. Expense drift. And I think this is a real thing people need to pay attention to. Expenses don't stay flat, they compound upwards. All right. So that is one of the reasons that when we underwrite, you usually do want to have that rental increase. Somewhere in there, you want to have some type of way to capitalize and recap money because if you're making the same money year over the year, you're losing money. We see inflation right now, you're losing money. So if you made $1,000 last year and inflation's at 6%, well, you made 6% less, right? You made 940. Right? What's it? The 6% of, am I right? Is that good math? You made 940, right? It's a big hit. Then compound that over year, it starts to hurt. Insurance costs rise unpredictably. That is 100%. Know that your insurance is going to rise. I've never had a good year run when insurance stayed the same or went down, right? You might have small, same, but usually expect it to rise. Property taxes reset over time. So when they do go to evaluate your taxes, make sure you understand your taxes are going to go up. All right. Maintenance increases with property age. We're starting to see that. All right.
Now, on the property tax and stuff too, especially as your portfolio grows and you have more and more properties, got to watch those things every year when they come out. You can absolutely, if you've held a property for 5 or 6 years and you haven't done any major renovations and you see a 10% increase in your property value for your tax reasons and stuff like that, you can absolutely go and fight that and and challenge it. And there are, I know in Petersburg, Virginia, just south of Richmond, they are famous for not doing anything on their taxes. And then one year, everybody's taxes just goes up. Blanket statement, everybody in the city, we're just going to increase 18% property values, right? And I know a lot of investors that ended up paying a lot more in taxes. And I know other investors that fought it and got it taken completely down because it wasn't justified. You have to watch it, especially as your portfolio grows.
Yeah. And then finally, labor and service costs inflate. That becomes everything from your HVAC tech to just regular day-to-day maintenance, etc. Those costs continue to go up. So you got to make sure we looked at a property today. The tenant was in a one bedroom was paying $555. Market rent is like $900, right? So as those expenses go up, you start to eat a little bit away at where you need to be profitable. And then it starts to become delayed maintenance, etc., delayed capex. We went and saw some property today, and it was a lot of capex that wasn't kept up with. And that's one of the telltale signs of you aren't charging enough, there's not enough money or revenue coming in. So, and that's usually what happens with landlords. You might see like tired landlords, right? Oh, I got to do all this maintenance, everything's so expensive. Yeah, we understand. What's your rents? And then you look and it's like, wow, damn, how have you made it this far? And one of the reasons that they made it that far is they don't have any mortgage. So to keep it comfortable, but that expense drift is a real thing.
That's where a lot of landlords, they're not putting away money for capex or planning those capex repairs and things like that. Like a hot water heater, it's going to burn out at some point. This is all there is to it. An HVAC is going to blow out at some point.
Got to replace the roof.
A roof is going to fail at some point, right? Like, I mean, you can get slate roofs and metal roofs that are supposed to be lifetime. Shingle roofs are good for 30 years, right? I know a guy who runs a roofing company. He's been doing it so long that he's actively replacing the roofs that he put on 30 years ago. Like, they last 30 years.
Yeah. So all things to think about when you are analyzing underwriting a deal. Rent growth assumptions. And that is where we are at now.
Yep.
Okay. Rent growth is not guaranteed. It's cyclical. There are times you're going to have great rent growth. COVID, we got tons of appreciation, probably more than we would in a decade. We got in a matter of 2 years, 3 years. And people thought, man, this rent's going to keep going up. It's going to keep going up. It's never going to go down. Not only has it stayed flat, it's gone down in a lot of areas. Okay. So they can flatten, they can decline. All right. Things that encourage it to decline are population, inventory, right? People bringing on new units, better new units, right? You got to pay attention to your competition. Supply increases pressure pricing. So more supply. Tenant affordability limits growth. If they can't afford their gas, they can't afford the rent, right? Can't afford the groceries, can't afford the rent. So this is actually not a good time. Incentive reduce effective rents, right? So especially when you're looking at competition who has rental assistance or rental like incentives, hey, rent here, get pay your security deposit, get 1 month free, 2 months free. There are places doing 3 months free to get tenants in, right? You pay the first month and then they'll give you 3 months free, or they prorate it over the course of how many, you get a big discount, hopefully to lock new tenants in. You're competing with that.
So they're advertising at $1,000 a month. Easy math is what I'm doing, right? So they're projected to make $12,000 a year on their unit, right? But you've got to price yours to make $9,000 a year to be competitive.
Yeah. So I mean that's one thing that can crush you in a rental market. So be locked in on that. Stay tuned in on that. That's why we always tell you guys to check your comps too. You can go ahead and change the slide, but we tell you check the comps before you list something. You never know where it's at.
Know where the new developments are too, because that's one of the big things that, I mean, Trump's talking about, like the big institutions not buying houses and things like that. Like the big thing in the since COVID with the big rent growth and things like that is guys like BlackRock and these big hedge funds not buying up single families to rent them out, but developing, build the rent instead of buy to rent. And when that happens, they're fighting off that growth in maintenance costs and that grows over time, because it's brand new. So they don't have a bunch of capex for the next 10, 15, 20 years. So they're locking in that stuff. So it's pretty smart to do it. But they're also like, if they come into an area and they put in 100 single family homes for rent and price it at market rent or $50 below market rent because they got 100 units that they need to fill, that's going to affect you. Not only are there people at, in your market that are competition now and stuff like that, but it's also better product, right? So you're going to have to undercut them. The only way that you're going to be able to add value if you have a 30-year-old product that hasn't been renovated in 10 years is to undercut the brand new renovations. And you still may not get it because people love brand new.
Yeah. Or dump a bunch of money in your property to try to even get it up to what
Right.
they are. I saw a property the other day. They had beautiful cabinets. They're using a commercial grade carpets and carpet squares. I'm like, man, it's a pretty nice looking property, right? And so just staying in tune and knowing like, hey, this is what's on the market. This is where my property needs to be. Do I compete with them? Yes or no? This is one of the biggest things that we're seeing right now. I think this is something that a lot of people aren't speaking about. Then it's the finance and reset risk, right? And we're at that point. You got low interest rates in COVID. You got 2%, 3%. Commercial debt is usually going to be fixed for 5 years, right? Same thing with some residential. Some people buy on a 7/1, 5/1, 3/1, where you might have that interest rate fixed for a certain amount of years, and then it goes to variable or floats. And it's one of the most dangerous things to do, ladies and gentlemen. Okay, because you never know where the market is going to go. Lenders might be like, yeah, what do you think? You think the market's going to go down? They don't care. They want to get their loan in, right? Here's the thing. Rates, as we see, can go up. They can go down. Your income does not fluctuate with the rates. Remember that. Okay? So your rate might be higher at refi. A property I just had, I bought it with a 3% rate. Interest rate just went up to 7. Okay? Luckily, I bought right. But if I didn't, I'd be in trouble. I know some other people that are in trouble. DSCR may not qualify, right? So that is something to worry about too.
So with higher rates.
Yeah.
So it's in. So for those that don't know, DSCR is debt service coverage ratio. So it's in the name, debt, right? So if they're offering loans at 7% compared to what it was at 3%, your debt is higher just because the interest. So your debt coverage ratio, you're going to have a worse debt coverage ratio. That's the 1% rule is like is the same type of situation, right?
Yeah.
It's the same scenario with DSCR. With higher rates comes along worse DSCR rates and therefore stricter lending guidelines.
Yeah. And speaking of that, lenders start to tighten their standards. And that's one of the things some lenders, especially during the last financial crisis, during COVID, they went pens off. They weren't lending. Right. So this is why I always recommend, especially right now, if you can get lines of credit, because equity might be trapped in the next few months. So if you can get lines of credit, if you can get some equity somewhere that you could tap into in an event that you need it, have it ready. Don't wait. Banks don't want to give you money when you need it. They give it to you when you don't need it. That's the reality of how banking works. When I needed money, I couldn't get any bank to give me $2,000, $5,000. I don't need the money. Mr. Grip, would you like $25,000? Sure, I'll put it to the side. I don't need it. Right? So be cautious of this. One thing I want to talk about too is a cash in refi. We talked about this at our meetup the other day. And that is something that could happen too, right? Because you guys could have bought a product at 4% with fixed debt or short-term debt, and then come time to refinance, and there's just not enough money in the property. Interest rates have gone up. You don't get the appraisal you wanted. And sometimes to refinance, you might have to put money back in. It's called the cash in refi. So a lot of times we talk about the cash out. There are cash in refis too. And it sucks, right? You might have to put in 10, 50. I mean, there are deals for some of these commercial deals where they do what's called cash calls, where we hear about that private equity. They're having to put money into their deals to make sure that they stay liquid.
Yep.
So
Yeah. For every action, there's an equal and an opposite reaction, right? If there's a cash out, there's a cash in.
nobody ever talks about it though. So I want to make sure I made you folks aware because there is a other side to this.
Nobody wants to do it. That's why nobody talks
Oh,
about it.
of course.
Everybody wants to do the cash out. Not only is it cash out, you get cash, but it's tax free because it's a loan, right? It's cash, it's free money. Everybody wants free money.
Hmm.
What about the money that cost you $50,000 to get?
Yeah. I mean, sometimes it might be, you might not even have to cash in, but you might just have money stuck in a deal.
Yep.
Money that you were expecting back. So that cash out refi isn't really cash out.
Yeah, your purchase with your bridge loan, it may have took $20,000 to close and do closing costs and down payment and things like that. So you're technically going to do a cash out. You want to pay off that debt, put long term debt in there, and pull your 20,000 that you put in out. You won't pull anything extra out. You just want to get your money out of the deal. May not come back that way. Maybe that they'll just pay the debt off and that's it. You got to leave that 20 grand in there, and then your cash flow has to pay you back.
Yep, 100%. So the other side, the financing is a big part of this.
Huge. Somebody a long time ago, when I was really new, a guy that does a lot of Burr strategy stuff in Richmond, Virginia, did a presentation at ARIA for us. And he said something that was golden in his very first thing. And he said, Burr, buy, renovate, rent, refi, repeat. All that's great. Refi is the only one that's important, though.
Mm.
That's what you need to look at first. If you can't do that, you'll never be able to do any of it, right? Doesn't matter what you can buy. If you can't refi it, don't buy it.
Yeah. Okay. Liquidity illusion. Um,
So big right now.
so I think this especially applies for multifamily. I think that's one of the biggest things. Single family, I will 100% agree. Most of the time you can get in and out. You have a buyer's market, you have a seller's market. If you have a single family house, as long as you bought right, you should be able to get out, right? You can always sell and hopefully get out unscathed. Now, I'm helping people right now sell a house. They paid too much for it and they're trying to sell it, and the market isn't what they thought. So they thought they had some liquidity. It turns out you really don't. Market's changing, your interest rates are going up, kind of kills you. With multifamily, liquidity is just that. It's an illusion and it's a timing. Okay. Because guess what? We got cap rates, interest rates go up, cap rates go down. I can't really get as much as I once wanted for my property based on our interest rates. Um, the other key is that there aren't as many buyers, right? So multifamily, liquidity is pretty much dependent on the market. Like you are a victim, you are a true victim to the market. Guess what? If nobody's buying multifamily area, oh well, right? You're gonna have to take it and sell it for a deal, or sit on it on a market for 200, 300 days. Be prepared for that. When I sell property, I sell it because I don't really need to sell. I understand that, all right, I could wait. If I get 200 days on market, I don't care. It's not hurting me. Right? If you need to sell, that's the worst time to sell a property, actually. Because people could pick up on that weakness. People will. So that's my 2 cents.
There absolutely is. Like this is kind of that perfect storm, even in the single family. Um, people that listed in February, seeing interest rates change and gas prices change and everything change as rapidly as it has in the last 30 to 45 days, right? Like it has changed the buyer sentiment. If you talk to realtors at all, I promise you will hear that the month of March in 2026 has been one of the bloodiest months for a realtor in the real estate market, right?
Yeah.
Buyers that were gung ho, ready to go, they dropped out. Buyers that were pre-approved with funding fell out because their debt to income ratios changed because their interest rate changed and now they don't qualify. Like it's such an intense, like complex system when it comes down to it. And one little thing, it's all it takes to screw it up. Ray and I say it all the time when we buy houses and when we sell houses. It ain't sold, it ain't done until the closing table is signed.
Yeah.
Period.
Yeah, I don't even get excited going. It's exciting to go under contract, but then that's when the work begins. right? So you can go under contract. Don't count that money until the paperwork's signed and the check's right in front of you,
Absolutely not.
right? I just heard of a story. Somebody backed out at the closing table 2 days before it's supposed to close. So somebody was relying on that money, ready to move, and now they're stuck in their situation because somebody else didn't. So these are
There's
real scary
very
because,
little recourse for that,
yeah,
especially in the retail transactions when you're buying and selling with agents and different things like that. You're a retail buyer. There's very retail seller, right? If you're selling your personal home through an agent to another person that wants to live there, and they back out 2 days before closing, honestly, you have little to no recourse almost all the time. You might get $500,
if that, yeah. So
if that.
they'll find an excuse to get out of it. There's tons of reasons to get out. Oh, appraisal didn't appraise or something like that, or boom,
Mhm.
and they're out.
Yeah.
So just stuff to think about. You got the operational risk. Long-term returns depends on execution, not projections. I think the biggest thing is one, making sure that your places are clean, habitable, and that you manage your tenants, right? Um,
It's the
having good
process.
tenants, huh?
Comes down to process, right?
Yeah,
The when it comes to a buy and hold, with a flip for sure, there's process involved with that, and success and failure depend on it. But especially on a buy and hold, when you're going to hold something for 10, 15, 30 years down the line, if you don't have a process in place for that, it will wander very quickly, right? And you'll feel it 5 years, 10 years down the line. Man, if I'd have had this in place 10 years ago, how much more money would this property have been making me? Right.
yeah. Um, so just know the cycles, vacancy rates, or vacancy. When is my property more likely to be vacant? Is it summertime? Is it wintertime? Wherever I'm at, my demographic. Making sure you have good property management, because you could miss money, you could miss some tracking. Um, bad debt increases downturns. And then also making sure that you are staying on top of your property management. I think that's going to be the biggest thing, just a good management system, communication with that management, making sure your rent's being collected, making sure, things are operating right, your tenants are happy. Um, you should be all right if you can manage that. But if not, you're going to have some issues. The last thing you want are tenants to move out of your place that you thought was good because of some stupid issue.
Yep.
Real rule of holds. Underwrite conservatively. I, Seth gets on me sometimes. I'm a stickler for being cheap and saying like, I don't know. I don't know. Um, be conservative though, because the best part is, hey, look, oh, those numbers were true. All right, cool. Oh, we were wrong. It was way up. Great. Holy smokes, we made some money. Um, so price that in up front. Assume higher expenses. Um, is maintenance going to be more? Usually, if I'm underwriting something, I'm running 30% expense. So if it's some older, I know some older guys, they're running like 40, 50% expenses, especially on older property, something pre 1990s and like 1940, 1930, they're running 50% expenses. I think that's a little bit drastic, but I mean, still run it to be safe. Plan for weaker rent growth, very possibly so over this next 5 years. I wouldn't expect much growth. I think we got a lot of the growth up front. You might see, typically we would see 3%. You might see a 1%, maybe a little bit of bump, especially with all the building that's going on. I wouldn't think about much growth right now. Okay.
The only way that you're going to see rent growth is with like a sizable amount of rent growth is with like a true like recessionary period where you have massive issues, higher, I mean, like double the foreclosures even that we're seeing now, right? Just more and more people getting away from the cheap debt that they have. 90% of homeowners, not 90, but a good portion of homeowners right now are locked in at that low rates, and that's why there aren't as many buyers in the market right now, because it's actually more expensive for them to buy another house because they're going to pay a worse debt, right? So if it gets to the point where those folks get to the point where it's unaffordable and they enter the rental market, you will see rent growth. Until then, we cashed in early.
Yeah, I think we're stuck. I read something by I think his name's Michael Burry. He predicted, the guy from The Big Short. But he was talking about the rental market. I was just reading it a couple minutes ago before we got on the call. Um, and it was absolutely true. Most people are stuck in their homes, right? We are victims to our homes because of an interest rate. I looked at selling my home. There's a house down the street from me. It's going for like a 188 a square. Man, that's a great price. Looked at selling my home. I'm like, man, I got a lot of equity in it. Here's the problem: replacement costs. I can't find the same house that I have now for that price, right? It just doesn't make sense for me fiscally to sell my house. So where people would have been selling, moving, transferring houses, etc., we're not having that right now because the market's in a tough place. People are staying where they are until something forces them. And I think right now, right, because that was always the thing, like, what's going to force people to leave their house? This is the force, right?
Of it.
Yeah. So
Hopefully it doesn't happen,
I hope
honestly.
it doesn't. I hope it doesn't. But I think
But
we're here. I don't think there's any
it's
going back. It's been unearthed. Yeah, let me see. I just read this before I got on the call too, because it only gets worse from here. Um, Google research reveals quantum computers may be able to crack Bitcoin's private keys in just 9 minutes. So it only gets worse because we are in the beginning phases of AI. We haven't gotten to quantum computing. So another 4 or 5 years out. After that point, these things that we have in our hand are dinosaurs, right? Like what we think we know of AI is a whole different world and a whole different brain. Um, so be prepared, build a margin of safety, have reserves.
closer than 4 or 5 years.
Huh?
Closer than 4 or 5 years.
Maybe closer, yeah. Before it gets to the masses. Before it gets to the masses.
Yeah. But closer than you think.
Yeah. But build a margin for safety, have your safety nets, like Carissa said, make changes. I'm a big fan. I plan for the end of the world, right? Have those changes in place because you never know. The worst case that happens is that you have some money on the sideline, you can invest, right? Have something that's somewhat liquid that you can get in and out of. Um, Stocks could be liquid, cash is liquid. Have some money on the sideline though for if something happens. Like I told you guys, we had that fire. The insurance took the check, they paid off the mortgage. I'm paying for the rehab of the building out of pocket. I had to have some liquidity. I had to tap into my liquidity for that. This is a prime example of buying hold of what can happen. You have to have that because if you don't, you go belly up. I'd be forced to sell a building, right? So I don't want to put myself in that position. I don't want to put anybody in that. So I'm paying out of my own liquidity, but you have to have liquidity to do so. So have that safety net, guys. Tomorrow, 12 p.m. Eastern Standard Time, we'll have our call in a circle. If folks want the link, send a DM, send us a call. We'll love to have you on. We talk about your deals, what's happening in your markets. We want to hear from you folks there on our call. And then next Tuesday, why good deals still lose money? I think, is this Easter Sunday? This Sunday? I think it is Easter Sunday. Happy Easter Sunday to everybody celebrating. I think it is Easter Sunday. It is. Happy Easter Sunday, everybody celebrating. Just give you guys a shout out or whatever you may celebrate. Passover, Memorial Day, whatever it may be.
Yeah.
And then Seth, send us off with a quote.
If you don't ask for the deal, you won't get it.
Amen to that. We just asked for a deal today. I think we got it. So go out there, start making offers. All right.
A seller that mentioned a number and we offered them 50% of that number.
Yeah. Yep. And it's a win for everybody. Right.
If you don't shoot your shot, I promise you, you will not make a goal.
Yep. All right, everybody. We'll see you guys next week or 12 p.m. tomorrow, Eastern Standard Time. Thanks, guys.
All right, guys.